and thanks for listening to the Adulting is Easy podcast. This is your host, Lauren, and today we're going to make adulting easier by making money easier. Please take a second and rate and review if you can when we're done. I'm joined today by Yonah, a powerhouse with property owners' tax savings. As business director at Madison Specs, a national cost segregation leader, he has assisted clients in saving hundreds of millions of dollars on taxes through cost segregation. He has a background in teaching and a passion for real estate and helping others. He's a real estate investor and host of the top podcast, Weiss Advice. Thanks for joining me, Yonah.
It's a pleasure. It's twice as nice when you hear it like that.
I'm excited for today, but before we jump into it, I want to introduce a new sponsor this week. So, are you looking for operational gains in a brand build? Meet the easy-to-use platform that transforms your docs, PDFs, and emails into branded information that guests read and engage with time and time again. TouchStay is in the business of helping hectic hosts and managers kill the time burn with simple tech. So this is for your STR hosts and managers. They help you reinforce your brand through communication, skyrocket the guest experience, and create raving loyal fans. Their digital guest welcome books are rich with features, including guest email collection and first impressions feedback capture, plus free email and SMS guest memos. In addition to providing a single piece of information and inspiration to get your guests excited for their stay, appreciative of your offering, and happy as Larry to tell everybody about it. Guests love TouchStay digital guidebooks as much as hosts, even mentioning them in their reviews. So if you want to look good every time someone has a question, look up touchstay.com and start a 14-day free trial today. Again, that's touchstay.com. So our goal for today is to make adulting easier for listeners by discussing a personal finance topic, since managing money is a big part of adulting. So Yonah, you and I are going to talk about short-term rental taxes, and you're going to school us on cost segregation studies. But first of all, can you tell us why we should care about our taxes?
Well, I think you should, since taxes are the number one expense that any individual or business has in their lifetime. And so if you have legal ways to actually reduce your tax liability and pay less taxes, some would say it's a duty, but others would at least say it's good practice. So I think, if you want to keep more of your own money and give less to Uncle Sam, this is probably an episode you want to listen to.
Absolutely. And I think we do all feel that way. How did you get into this field, though?
Really, really weird. When I was growing up, I always wanted to be a cost segregation specialist. And no, just kidding. I'm just kidding. That, I didn't know about cost segregation until about 6 years ago. And what surprised me, I was doing real estate for a couple of years prior to that. And prior to that, I was, as you can tell from the gray hairs in my beard, I was a teacher for about 15 years. So my passion has always been teaching and helping other people. And in getting involved in real estate is a story for itself. But I was literally just introduced to this company, was open to opportunities, and something, an incredible story actually of two of my friends meeting that I didn't even know about. And one said to the other, "Hey, Yonah would be great to work at this company." And the other one said, "Okay, let's get him a meeting." And the rest is really history. So it's kind of strange how I got into it. But what surprised me the most from the very beginning until this day is how few people even know what cost segregation is, let alone understand it and use it. It still, to this day, surprises me.
So something that I've noticed over time is that very few careers have no surprises in them.
Yeah.
I'm in sales, so it's always been that way, right? You're like, oh yeah, how did you get in sales? Nobody's like, what I wanted to do. I wanted to get in sales. Like I didn't major in it in school or anything like that. So I love hearing that though. So let's just define it then. What is cost segregation?
Cost segregation, right? Really weird kind of name. What all it means is breaking down the cost of your property into different categories of tax deductions. Okay, so when you buy a rental property or any type of business or investment property, besides your primary residence, you can take this tax deduction called depreciation. Okay, and what that means is the IRS is saying, we assume that a property is going to go down in value, and everything goes down in value as time goes on, right? We're familiar with that. Like you drive a car off the lot, it goes down in value. But with real estate, it doesn't actually go down in value. But the IRS gives you this tax deduction based on that concept. And so you're able to literally take a small amount every single year That's called your depreciation deduction, as if it were going down in value. What cost segregation does is breaks down that cost into faster depreciation categories, essentially saying certain parts of the property, like furniture or fixtures or things that are non-structural, actually depreciate on a 5-year schedule much faster, and you can take those deductions at a faster rate. So simply put, kind of to recap, it's a cash flow mechanism that allows you to take more tax deductions in the earlier years of ownership.
So you said 5 years would be a quick depreciation. What's more of like a normal one?
So the structural and the what's called normal depreciation, what most people do is just over a 39-year schedule. That's the standard depreciation schedule. For residential properties, it's 27 and a half years, but short-term rentals are categorized like commercial properties from the IRS's perspective, so go on the 39-year category. So it's literally taking about a 2% deduction of your property cost every single year with normal, what's called straight line depreciation. Cost segregation allows you to put sometimes 20 or 30% of those deductions into the first 5 years. And so that's why it's so beneficial.
So is it mostly beneficial for short-term rentals, or can you do this for long-term rentals too?
You can do this for any type of property whatsoever. I mean, we do everything from office, industrial, storage, multifamily, you name it, any type of business or investment property can be done. However, it is more beneficial for short-term rentals typically than long-term rentals for a couple of reasons that hopefully we're going to get into.
Yeah, go right into it.
No, we're in already.
We're in. We're here. We've arrived.
So there's a couple rules that a lot of people don't know when it comes to taxes. And part of the reason why people don't know about cost segregation is it's related to taxes. And I guarantee you there are people listening to this now like, oh no, taxes. I'm going to tune out already. But the truth of the matter is, it's really important to understand the simple levels and not just tune out when anyone mentions anything taxes. And this is really simple. When you have a rental property, it's taxed differently than your other sources of income, like a W-2 or 1099. And so your rental income is considered passive income. Now, it's not really passive. Anyone knows that, right? It's not passive whatsoever, but the IRS categorizes it that way, which means that depreciation or cost segregation deductions can only be used to offset your passive income. It can't be used, unfortunately, with limited exceptions. It cannot be used to offset your W-2 income. So cost segregation may not always be so beneficial, except with short-term rentals. So there's one very specific rule that says if you manage a property that the average stay is less than 7 days and you materially participate in that management, which means you're self-managing it, you spend either 500 hours a year on all your properties together or 100 hours a year plus more time than anyone else. And so that's pretty much, you can't be have a property managed property. But once you have that, what's called the material participation, you can now use those depreciation and cost segregation deductions to offset your W-2 income as well. And this is something that not a lot of people know about, and is something that I've seen hundreds of people recently in the past couple of years really take advantage of because it's really not available to almost any other type of property.
Fascinating. And I remember when I was first starting out, 22 or whatever, and doing my taxes and things like that. And I remember my mom explaining to me, because they had a rental property, explaining to me the difference between active income and passive income. And then as I got my first rental property when I was 27, I remember thinking, wait, this is not passive, right? It's almost like it's like a misnomer. But so there's that side of it, right? Where it's kind of a misnomer in a lot of ways. I kind of don't like how it's categorized that way. Then the other side of it is people think you get like all these tax benefits with real estate, right? It's thrown around out there, tax benefits, right. But I don't think a lot of people know what those are. I think they think that you can, if you have a loss, right? And everybody kind of knows like depreciation, kind of fake expense, non-cash expense. So a lot of people have losses in real estate, especially if they're expanding their portfolio. They must be taking losses against their active income. I think there's this idea floating around as well.
There absolutely is that idea floating around. And if someone is a real estate professional, meaning they or their spouse are full-time in the real estate business, then they can actually use those losses against active income as well. But the vast majority of people kind of have this misnomer, like you're saying. They think that they can just use this depreciation against any income, and that's just not the case.
So you do not have to be a real estate professional to do cost segregation.
You don't have to be a real estate professional to do cost segregation, but again, the limitations of how you can use those deductions are going to be there. So unless you're either a real estate professional or it's a short-term rental and you're using that material participation rule, then those losses or those deductions are just going to be limited to offset your rental or quote unquote passive income.
So, what are some of the tax benefits? Maybe putting cost segregation aside for a second, what then are the tax benefits of getting into real estate in general?
So there are, I mean, like you said, it's thrown around tax benefits of real estate. The biggest one clearly is depreciation, but there are plenty of other smaller ones that maybe go unnoticed. I mean, simple things like you may not know that the mortgage expense that you spend if you buy a property and have a finance with a mortgage, you can deduct that expense. You can deduct, other insurance expenses, things like that. A lot of business expenses that are involved in the rental property business, you can actually deduct those from your income. And so you're only going to be taxed on the remaining amount. So that's something big that happens, not just with real estate, with any business truly, but real estate specifically with the mortgage expenses. That's one. Another big thing is that a refinance, which this blew my mind the first time I heard about this, right? Is if you do a refinance of the property and you get cash back, which happens when the property goes up in value and you can get it appraised higher and then pull out money from that cash out, what's called cash out refi or cash out refinance, is not taxed. That's money you can just take from the bank and put in your pocket, is not taxable income. So that's another huge tax benefit. According to that, there's obviously the 1031 exchange, which is another great way to scale, to defer capital gains tax by exchanging one property for another instead of selling it outright. And so the list really does go on, but true to today, that cost segregation and depreciation is probably still takes the cake. To paraphrase, Tom Wheelwright. If anyone wants to read a little more, he's got a great book called Tax-Free Wealth. So that's Tom Wheelwright. He was the Rich Dad advisor. And he says that he called depreciation the king of all deductions.
Okay, so cost segregation, it's really well named because you said we're basically going to categorize these costs, right? You said structural 39 years for commercial, 27 and a half for straight line depreciation for residential. What are these? What's a category outside of structural then? What are these? What are you literally doing when you do a cost segregation study?
So there's really four main categories when it comes to depreciation. One is land. Land does not depreciate. So you always have to subtract a certain amount from your property, from your purchase price, and that goes to land. You can't depreciate that. The remaining amount is going to go to three things. One, the structure. And structural components is like the walls, doors, windows, roof, foundation, all that stuff, infrastructure. And that's going to go in 39 year. And that's always going to be the majority of the depreciation is going to go in that category. The other two are what we're identifying with the cost segregation study. And it's an engineering report, essentially breaking down the components of a property. So the first category is called land improvements. So not land, but what's on top of the land. So you think about landscaping or pavement, concrete, if you have a parking lot or a driveway or sidewalk, any of that stuff, all of that actually depreciates. Fencing, stormwater drain systems, retaining walls, all these kind of things, all can go into that land improvements. And this could even include very common in short-term rentals, a swimming pool or outdoor patio. Patio furniture is maybe in the other category, but we'll get to that. A gazebo, all these kinds of things, all will go into this 15-year land improvement category. So you can accelerate the depreciation of the value of those things. Once you add them up, you say, okay, swimming pool costs $50,000, right? That you can actually take as a deduction over that 15-year period. The fourth and final category is usually the biggest when it comes to cost segregation, and that's called 5-year personal property. And so this can include anything that's inside a property that's non-structural, from furniture to appliances, equipment, window treatments, you name it, wall coverings. Very common with like cabins, for example, is the flooring, wooden flooring, or wooden wall coverings, and so many other things. All of those and many more, I'm just listing a few, will go into that 5-year depreciation category. And both of these 5 and 15 are extremely beneficial because of something called bonus depreciation also, which allows you to take those accelerated deductions in the first year and not just spread them out over those 5 and 15-year schedule, which is extremely beneficial, but actually to take a lump sum in the first year.
What if you depreciate so much that like you just have like big losses? Like, would you rather spread it out over the 5 years, or do you just take it all in the first year and then carry that loss forward? And sorry if that's a stupid question.
It's not. It's a really great question. And really this comes to, back to tax planning and really understanding what your individual situation is and seeing how you as an individual can benefit most from the depreciation. Is it better to spread it out, or is it better to take that lump sum and have those losses? And again, if you can use those deductions in the first year, if you have other active income, then it's a great way to just reduce that taxable income, create more cash flow, because that money you can reinvest. I mean, think about it. Instead of paying the government your own hard work money, you can actually reinvest that, compound that, and grow more wealth through the time value of money.
So this is for real estate owners, right? It's not like property managers can't do this, co-hosts, if you will, people that are doing arbitrage where they're renting a property out um and then putting it on Airbnb, right? This is for specifically owners in terms of specifically the cost segregation and depreciation.
Correct. So depreciation is limited to owners of real estate. However, someone who is doing arbitrage or that co-hosting type thing where you actually spend, which is very common, spend, some money on furniture and things like that, you can take those as deductions. So it's not like they're not going to get any benefit from this. It's not always, they're not going to take the depreciation deduction of the property, but whatever money they do spend in the setup costs can actually be used as tax deductions.
So I wanted to circle back too to something you said earlier when we were talking about being a real estate professional. And if you were your spouses, then you can take losses against passive losses, against active losses. You can do that without a cost segregation study. Is that the idea? But you need the cost segregation study if you're not a real estate professional?
So what happens when you do a cost segregation study is you create these deductions, right? And how you can apply them is going to depend on whether you or not you're a real estate professional. If you're a
Okay.
real estate professional, you can use those deductions against your active income, W-2, your spouse's W-2, or if you're a broker and you have a lot of, commission income, whatever it is, that's where it's beneficial. So if you're not a real estate professional, those deductions are just going to be limited to offset your passive, your rental income, which can still be beneficial on its own, especially with short-term rentals. Even if you're not materially participating and you're not a real estate professional, you still may have a lot more revenue or income or net income on your property than a traditional long-term rental would, and therefore you would be taxed on that. So it could still be a great strategy to use cost seg to, reduce that taxable income in the earlier years.
Okay. What if you are materially participating, but you're not a real estate professional? Can you go against active income? That's a question I get a lot, actually.
Yes. So again, that's the really main difference with short-term rentals. And this,
Got
it's
it.
great to just reiterate it. No, say it again, say it 10 times, because the more we repeat something. And again, my background as a teacher, if we can say it, 10 different ways, as long as it's gonna, get in there and realize this. This is why short-term rentals are so beneficial. You, even without being a real estate professional, you can use these deductions against your your W-2 income, which is not the case with any other type of property.
Incredible. And I love it. And I asked my accountant about this, and he was not stoked about it. He's like, "Where'd you hear this from?" I was like, "Twitter." And he was like, "Oh my God, blah, 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 blah." He's like, and then he kind of went into the real estate professional thing. He's like, "You guys both have W-2s. You can't be a real estate professional." I was like, pretty sure I read in that thread that you didn't have to be.
Right.
As long as you're active, right? I mean, we're very, we don't have a manager or anything. Now, my question was, what about the cleaners? Because my cleaners are in and out all the time, whereas I'm not cleaning. I'm just kind of managing and stuff. So
Yeah.
like what if they have more hours than me? That would rule it out, right?
So with that rule, one of the passive activity rules is 100 hours a year plus more time than anyone else. So any
Right.
other individual. So if you do have one individual on that property, and it's not like multiple cleaners, for example, and they're actually maybe spending more time, so then yes, that would be a problem to to qualify you for that material participation.
So get a fleet of cleaners. Okay, got it.
Get some rotation.
So then coming back out of just the cost segregation conversation again, what do you see real estate owners doing wrong when it comes to taxes?
Well, the first thing is not really being educated. And just to your example, unfortunately, there are a lot of accountants who are not very educated when it comes to all things real estate. Think about it. Tax code is huge. It's massive. Not every accountant specializes in real estate. And if you're a real estate investor, you want to make sure that your accountant, if not specialized in real estate, at least has a pretty good understanding, or at the very least, be open to further education. Because to be honest, there's no possible way that every accountant can know everything there is to know about everything in the tax code. And I used to give webinars to accountants for further education, CPE courses, like continue education in order to retain your license year after year. And I used to ask, and I literally gave this to thousands of accountants. I'd have, 100, 200 people every single time that came on and did this for a while. And I would literally ask the question in a poll before they started, what is your familiarity with cost segregation? And, A would be, this is the first time I'm ever hearing of it, right? B would be, I know what it is, but I don't really understand it. Like C is like, use it all the time for my clients, et cetera. And so the vast majority, I'm talking like 80%, were in those first two categories, that they never heard of it or they've heard but didn't know. And I'm talking about accountants here. So don't be, if you as the property owner have to educate your own accountant, I mean, that's a challenge. You obviously want to preferably find someone who already knows what they're doing, or again, at least is open to education.
Yeah, that's the conclusion we are coming to. And there's a difference too between somebody who does a bunch of long-term rentals versus somebody that does short-term rentals. I'm sure they're like, let's say you're like, yeah, I know real estate, but what you've done is help people that have, a couple of single family homes or whatever. That's different than somebody who's running this fleet of short-term rentals. The accountants we use right now are the same that my husband uses in his engineering firm. And we've switched accountants a couple times. We're still trying to figure it out, is my point. And I think that's okay. Right. And we're thinking like maybe we'll have them do it and then if somebody else review it. Right. So, I mean, there's real estate, people talk about like just simply build your team. Simply find a good real estate agent. Simply find a good lawyer. Simply find a good accountant. Simply find a good handyman. And it's not easy. I don't know anybody that gets that right the first time. I mean, personally, I've gone through iterations on all of those things, and I think that's okay. But yes, that's what this podcast is about. That's what educating yourself is all about, is almost making sure that you can ask the right questions.
Wait, so it's not easy?
Real estate is easy.
Oh,
Adulting's
okay.
hard. No, I'm just kidding.
Sorry.
And we're making adulting easier. We're making real estate easier. We're
We're making it
making life
easier.
harder for our accountants. That's what this episode is all about. So question then back to cost segregation specifically. How much does it cost? And I know it depends, but for like to do a cost segregation study for a property.
So it does depend. I mean, for short-term rentals, single families, we have pretty much standard prices. And like I said, we're the biggest national company that does this. I got in trouble because a little over 2 years ago, I was on a very popular short-term rental podcast. And I said like what our current fees are. And like 2 years later, I'm still getting people like coming to me, even though our prices have risen since then, because everything in the world's prices rose with inflation and everything. So currently I can say that we charge around $3,000 for a full cost segregation study on single families. I can't say that that's going to be the case going forward, but currently that's what I'll say. And it is not contingent. I just want to make this very clear. It's not contingent on your tax savings. It's not contingent on your purchase price. It has solely to do with the scope of work involved, and the type of property it is. So when we're doing like a multifamily, it could be around $5,000-$6,000. If it's a 300,000 square foot office building, it could be like around $10,000. It's obviously has a lot more to do with the amount of work involved with our engineers and studying the property, et cetera.
Right. And it's not just for short-term rentals. It's just short-term rentals. There's almost this like hack in the tax code that makes it even more valuable in that situation.
Right.
So what's one thing that listeners should be doing when it comes to their taxes? What's one thing they can go home or they're in their car, they're driving, you guys are driving, you're cleaning your kitchens, you're in the shower, you're at the gym, whatever. When they're done doing that, what's one thing they can do to make their lives easier with their taxes?
I would say maybe just hit rewind, go back to the beginning, listen to the episode again, because I doubt everyone got everything that we talked about up until now. No, but seriously, reach out to your accountant. If you have a rental property or two or any, reach out to your accountant and ask them if they know about this thing called cost segregation. And if they know this thing called, short-term rental material participation. If they're not familiar with it, point them in some directions. There's, like I said, there's books out there, there's podcasts, there's material out there. And again, it comes directly from the tax code. This is not something that we're inventing or making up. So that's what I would say. Continue the education of yourself, and if need be, your accountant, and if need be, right, find another one that does specialize in real estate.
Got it. So Yonah, is there anything else you want to add before we wrap up?
That's probably the most important thing. Just make sure you're on board. Taxes are not something that every individual should be dealing with. There's a reason why you have an accountant, and make sure that they're just on board with you and understanding your situation.
So even with one rental property, you think people should have an accountant?
Um, it's a good question. I wouldn't say they necessarily need to, but when it comes to cost segregation and these type of strategies that you're using, it comes a little bit harder to kind of juggle and put them in. I know TurboTax and these type of things don't necessarily fit well with some of these. It's not as simple to apply the depreciation as it would be otherwise.
Right. Got it. So why don't you tell people how they can get in touch with you and find your podcast?
Well, Weiss Advice is anywhere you listen to podcasts. Just search it out. I'm a big, nice, big black beard. So now it's gray, but in the picture, it's black. And that's where you can find me. You can find me on all the social channels also. I'm biggest on LinkedIn. That's where my biggest following is, and put a lot of content out there, but most recently on Twitter as well.
Yeah, that's how we met. Okay, I will put that in the show notes as well. Guys, if you like this episode, I would also suggest episode 125, getting started in short-term rentals and how to get direct bookings, or episode 112, how to set up your Airbnb step by step. And you can follow me on Twitter at Adulting is Easy, Instagram at Adulting is Easy Real, YouTube channel at Adulting is Easy. If you've been listening to this, you can check out some clips. They'll be over there on YouTube, or you can actually watch this whole thing again if you want. You can email me at realadultingiseasy@gmail.com. Thanks again for listening, everybody. Hopefully, Yonah and I have made adulting a little easier for you.